We have a trade deal, everybody. I guess. That's the news that's elevating the markets today. But the real question is, can we get something done on this trade war that really sticks and really matters for avoiding global recession? That's exactly what we are going to tackle here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we're going to take a look here at what is probably the biggest real event risk for the markets, the evolving relationship on the trade front between the U.S. and China. And take a look at some of the economic data that's informing the state of play here, as well as where we're going next. But first, let's take a look at the price action, because it is certainly of a more chipper variety here today, but again, very interestingly soggy into the end. So obviously we've had a blistering rally here for the S&P 500 as a kind of bellwether for overall risk-taking from the panic lows in April, what I've come to call the holy moly. This is the Liberation Day gap right here, and this is where the markets go, oh no, is this a sovereign or a currency crisis in the United States? And then as this volatility shakes out, the answer quite reasonably, I think, ends up being no, it's not, because even if the U.S. were to unilaterally withdraw itself from the global trading order that it has itself engineered, and which has the dollar and the U.S. Treasury bond at its center, there'd still be no viable near-term replacement for the dollar or the Treasury bond as the most liquid, most viable unit of commercial exchange and the most viable benchmark for riskless interest income that is available. And so with that, you still have the global architecture as it stands, and so the markets unclench and we get back to this starting line. We get a little bit of a pop yesterday in the wake of the Fed policy announcement, despite some initial unease with the lack of urgency at the central bank. But then really the news today is what gives us a slightly higher high here. If we go back and actually poke at the high that was there before Liberation Day going into the month of April, interestingly, we don't stick the landing. We don't actually manage to get over it, and we ultimately recoil back into the range for price action that has emerged since the beginning of the week. We failed to clear Friday's high. We failed to make headway through this resistance that lasts, and that we actually got all the way up there only to come back in, that can be a sign of technical exhaustion. We'll, of course, wait and see. But really, the question here of motivation is very juicy indeed, because what catalyzed this today seemed to be the announcement of a trade deal between the U.S. and the U.K. Now, obviously, this is not exactly the same thing as many of these negotiations, because, of course, it is the UK. It is one of our closest allies from the womb, as it were. Moreover, it is a country with whom we ran a trade surplus last year. Finally, the tariff of 10%, the benchmark tariff of 10% established by Liberation Day, which was itself a five-fold increase on the 2% average tariff that was there before then, that stands as a consequence of this quote-unquote deal. And I say quote-unquote because nothing here appears finalized. The UK is at pains to talk about ongoing negotiation as all of this is occurring, despite the triumphalism from the White House, because, of course, they don't like that there is a 10% tariff, even though there was a little bit of a carve-out to lower auto tariffs from 25% 25% down to that baseline of 10, it is still a lot higher than where we were before the calendar turned to 2025. And this is the 9th largest U.S. trading partner. It isn't the first. And so if what we're looking at here is optimism about the idea that deal making can happen and tariffs can come down, conceptually, the real test of that concept would be some progress with China, where, according to Treasury Secretary Scott Bessent himself, there is now an effective embargo on what is the world's most significant leg of the supply chain, the linkage between the world's number 1 and number 2 economies. So it'll be very, very interesting indeed to see if any of this holds up as Bessent heads to Switzerland to meet a senior Chinese trade delegation, ostensibly to kick off talks. And of course, before then, the posturing is loud and heavy. Asked whether he'd lower the tariffs from 145%, the president flatly said no, that he would not do that as an inducement for talks to proceed smoothly, that would be part of the talks themselves, although he did signal that the tariffs won't go above 145 and that they have a natural direction to come down from here, but said he would only do that as part of the negotiation. And of course, the message from China, the spokesman from the finance ministry there saying, if the U.S. wants to talk, it needs to stop exerting pressure. That is to say, we can talk about a trade deal, but you need to lower these tariffs first. So neither side wants to blink here, seemingly, as we head into these talks. And China has loudly said, well, the U.S. wanted this meeting. We still firmly oppose what they're doing, as if to say, we're not going to look like we scrambled to the negotiating table here. They are. And the U.S. is saying nobody is scrambling anywhere. And so both sides seem to want this off-ramp, but neither side seems willing to take a step back from the breach. And so it is with this in mind that we're going to get some very interesting economic data coming out of China to set the stage, because while there is a stalemate, it is a waiting game and beckons us to take a look at who is going to blink first, or at least where the economic damage might strike hardest. So incoming data out of China expected to show that export growth slowed sharply in April from 12.4% in March to just 1.9%. Imports, meanwhile, continued to flounder yet again, a negative number expected, down 5.9% year on year. None of this, of course, speaks to anything but weakness, and more importantly, that melt up in imports that you saw in U.S. first quarter GDP numbers. That, of course, looked like the front running of tariffs, as did the massive build in inventories. But China's key role in supplying that front running was, of course, firmly on display here. Going into the beginning of the year, we had a surge in exports, and indeed, even coming into the election last year, some pep there, but that has clearly started to unravel as front-running tariffs that have, of course, now already occurred has basically run out of runway. Meanwhile, domestic demand has been getting more and more anemic since the end of 2023, where it peaked, and that continues to be the case. As if to highlight that point, we have inflation numbers coming out of China expected to show another month of negative inflation, 0.1% year on year expected. That, of course, speaks to the absence of price pressure as catalyzed by demand for consumers. And then on wholesale prices, it's been all negative numbers for a long time, going back to the middle of 2022, and it's not getting very much better there. Again, speaking to how much throughput there is through the still most significant node of value add production in the global supply chain, how weak demand is for wholesale output, and so how weak the global trading environment actually is, and how much China is able to capitalize on it, which is obviously not very much. This continues to be a story of weak demand, both for consumers and for firms that supply both them and the external market. Now, earlier this week, we had the S&P Global and Caixin private sector estimates of Chinese PMI data. These are purchasing manager indexes, of course, as ever. 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, I should say, the faster the growth. The further you go below 50, the faster the contraction. Take a look here at the composite index, and you find a 3-month low on economic activity growth that's just hugging this 50 line. So we've slowed to near standstill, and current activity is the slowest it has been since January, telling you that indeed there was a ramping up in February and March, and then in April it seems to all have come undone. You can see that here in the breakdown between services and manufacturing, and you can see that manufacturing in particular has taken a dip here, ostensibly as this front-running of tariffs ran out of juice. Interestingly, the 3-month low on growth, that matches up with what we got from official sources. China, like the U.S., has two versions of these PMIs. One of them is from the China Federation for Logistics and Purchasing, which alongside the National Bureau of Statistics makes the government's version of PMI. And here, what you find is indeed standstill. The composite is at 50.2. Services has slowed, but it's really the story in manufacturing, which is, again, contracting. And contracting at some of the slowest rates we've seen in this entire sequence. We're basically at the bottom of the range for manufacturing performance going back to early 2023, which, of course, reiterates what we've been saying about China for quite a while. For 8 consecutive quarters now, China has had economy-wide deflation. That is to say, real GDP has run faster than nominal GDP, implying that the inflation adjustment between them is negative. That, of course, means that basically the whole economy is on discount. If prices are falling, then there is no demand to beckon them higher. And so the world's second largest economy is basically on life support here. It's treading water. It's not really going anywhere. Moreover, the deflationary gap is actually getting more severe over the past 3 quarters. So we're in a situation where China's economy still looks to be in very bad shape. But then on the flip side, of course, we got numbers out of the U.S. that don't paint too much of a better story. S&P Global PMIs give us a composite at 50.6, near standstill. If we look at what this compares like with the other set of PMIs out of the U.S., which also does too, that this one is from the Institute of Supply Management, there's a little bit of a difference in the components. So here the manufacturing is obviously weaker than it is here. It's 48 there. It's 50.2 here. Services is a little bit weaker here, 50.8 versus 51.6. But the upshot is basically the same. Both of them give us a composite level that is just above 50. And we don't have one calculated here because that's not the way ISM does it, but it's not easy, or it's not difficult, rather, to surmise. Manufacturing is a smaller component of the average here than is services. And so if you average these two, but you tilt it in favor of strength because services is a bigger deal, well, then you end up somewhere just above 50, give or take. So whatever the specifics internally, the bottom line is since the beginning of this year, we've moved off some of the strongest growth we'd seen in 3 years or so. You can see that across the board here, down to what is essentially standstill. And of course, when you compare that across the US PMIs, both versions of the ones from China and, for good measure, that of the Eurozone, you have convergence on standstill across all 3 of the major economies powering global growth. Whereas from the middle of last year, Europe and China were weakening into basically an idle state, but the U.S. was powering on at some of the strongest growth we'd seen, especially toward the end of the year, since all the way back in early 2022. Now, across the board here, we've ground down to basically standstill. And of course, we look at these 3 economies because together they comprise 58% of global GDP just by themselves. Never mind their knock-on effects on the remaining 42%, which are for the most part vendors that depend on demand from China, the Eurozone, and the US in order to have GDP contributions of their own. So if this is the story for the engines of global economic growth, that is convergence on idleness, well then it's hardly surprising that when you get the S&P Global's worldwide measure, the global PMI number that they put out alongside JP Morgan, you end up with a 17-month low on economic growth. And here's that pop in manufacturing around the front running of the tariffs. You can see it here. But that's hardly the bigger story because, again, that's a smaller piece that is services, and we can clearly see here, services has been steadily slowing, especially since the beginning of the year, and is now at the weakest levels we'd seen since the latter part of 2023. Take a look at the breakdown of the components. None of it is especially encouraging. Output growth, much slower. New business growth, much slower. New export growth has gone from growth to contraction. Future output, that is a measure of sentiment, sharply lower. Employment from growth to standstill. Outstanding business was shrinking, is now shrinking at a slightly faster rate. Input price inflation weakening a little bit, ostensibly because of demand destruction, but output prices actually accelerating, as if to flag that stagflationary risk that has come out of both the U.S. Activity surveys, the ISM, and the S&P Global, as well as the Fed itself, when Jay Powell spoke this week following the FOMC monetary policy announcement. Why do we care about this? Well, clearly we can see that this composite PMI globally has been a pretty good approximation of where global GDP is heading. And the trajectory here seems to be that the path of least resistance is still down. Come all the way back to where we are on markets and consider that if the path still is toward recession, if the US and China have converged on standstill where Europe was waiting for them and the global economy has not started to improve yet, then there is a long tail to any negotiation to really put this recession monster back into the box. And so it becomes very difficult to envision how you don't get a global recession in this environment. Now, maybe there's a China deal this weekend, or at least a very cordial meeting with a clear sign of an off-ramp. But the damage has been done. And it will take months in terms of recovery to even begin to see that there is a dip, and then to envision that after that dip, there will be a rebound. And maybe that's enough for sentiment if a deal is done. But as this posturing continues, the economic weakness that is the foundation, while the posturing goes on, suggests that the recession is very close at hand. And the question now is, can it be managed to something mild? And something that sentiment need not be worried about. And if not, well, then it's what we were worried about on the way to exactly where we are now. And although the proverbial holy moly may be over, this part of the story is still very much in play. That's Macro Money for today. We're here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. That makes this the last show of this week. Macro Money will be back Monday next week. I'll be on with Chris for Futures Power Hour tomorrow and on Mondays, as I am every week. I'm on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Thanks for watching. Macro Money's back next week. Happy trading.